And let's shift focus to our next discussion with Mr. Easwaran Subramanian, who is the partner and supply chain leader at Deloitte India. A very good morning and thank you so much for your time. The biggest talking point on the street is like how India will actually try to benefit with this sort of supply reallocation is what the globe is looking forward to. And yes, of course, the US tariffs coming in, the luxury companies will have to find a new marketplace outside China. Firstly, help us understand what makes this shift necessary and what changes might the luxury brands facing in identifying and now entering the major markets?
Thank you so much for bringing me in. I think two things to be kept in context. The first thing is, I think if you really look at the last 5 years, starting 2019, possibly till about 2023, 24, the luxury goods market fundamentally had an advantage of price realization or value realization. So increase in prices were taken up by customers and that contributed a lot to their growth more than volume realization. And a lot of that came in from China. You know, the Chinese market at that point was growing at roughly at about, I think for luxury goods at anywhere between 18 to 21%. So to that extent, now with that, and the last year it's been nearly flat, I think close to being flat. So this year, if you really look at where the priorities for luxury goods companies lie, they need to look at new markets. And I think in my opinion, I think that shift therefore becomes imminent because you have to replace that strong growth that they had over the last 4-5 years with new markets. And I think in my view, I think between India, looking at the Middle East and more specifically around the UAE and KSA, as well as I think towards other parts of Asia, I think these are the three regions that they will end up reorienting a bit this year. And I think that is necessitated given the fact that they might have some flat growth or at least some level of negative growth in some of the markets which are growing very high over the last 4-5 years.
Right. Good morning, Mr. Subramanian. This is Cheryl also joining in the conversation. So beyond China, are there any other emerging markets that luxury brands may actually consider as alternatives to, and what factors do you think might actually influence these choices?
I think, first of all, I think, and there are obviously markets, I think they have had some good run in countries like India. You know, for example, if you look at us, you know, we would be possibly be at this point of time, maybe a 6-7 billion market, but really have the potential to be a 30 billion market in our own estimates by in the next 5-6 years. So to that extent, I think they have opportunities beyond the traditional market. So India surely is one of them. And I think the average unit value that people are buying up is going up substantially. So India would be one. I think the Middle East, specifically, like what I said, UAE would be the second one. I think it's also a hub for sourcing a lot of gateway into the elite African market. So I think that would be the second one. And third, I think would be pockets in Asia, specifically in the East, that they would really focus on. So you should see some reorientation or focus on some of these markets in the next 12 to 18 months by the luxury goods companies.
So how might you think US tariffs are going to impact the manufacturing concentration, China, USA, and what alternative manufacturing locations you think could luxury brands actually consider? And how much then would India really stand to gain out of this?
You know, when you start looking at that segmentation, there are two things to be looked at from a reorientation of supply chains. The first one is wherever you have a high volume and low variety in the portfolio, especially in the luxury goods side, which means they're not hyper-personalized, I think you will still have them oriented in wherever the current footprint is. I think where countries like us have a major opportunity is wherever we have a low volume, high variety model, and where I think we have been traditionally been extremely good. And it also gives us an opportunity to transition to the high volume, low variety model, which is where I think the larger game for manufacturing would be. So I think in the short term, I'm sure companies, especially for niche portfolio, would start looking at countries like us, which have a strong base, right? You know, in many of these areas, especially in leather, apparel, as well as some of the personalized portfolio, we actually have some strong strength in specific clusters. Therefore, I am sure that the luxury goods manufacturers would exploit them, take advantage of this tariff model to really come and shift some of their supply bases. So I think that's really where I think the opportunity would be. And I think for India too, I think we also have an additional opportunity. Dimensions like the one district, one product portfolio that we have, I think we have a strong opportunity to integrate it with the global luxury goods market. So I think we have two opportunities. One is on the supply side, and the second one is obviously also to integrate some of our traditional strengths or our specific strengths and specific clusters, which means there is uniqueness in the portfolio, can be integrated into the global luxury market. So I think it's a good opportunity model for us.
All right. Other than that, what we are seeing is that the global outlook for the growth is a little bit subdued at this point in time, given the concerns around inflation. So help us understand, do you believe that maybe in the developed markets, there could be some implications or there could be some hit to the overall global luxury demand?
I think the way we have estimated, I still think that the market will grow at about 2 to 3% on an overall basis globally. Obviously, countries like us would go much faster than that. Maybe even if it is subdued in the second half of the year, you will still run a 1 to 2% growth in the market. But the important thing is that this market would predominantly be a lot to do with volumes rather than the value realization models that the luxury goods companies were able to run over the last 4 or 5 years. So to that extent, I think pricing would be an important consideration for them. So to that extent, I think the growth would be there in new markets, like what we discussed. Growth would be predominantly through volume realization models, but essentially value will have a revisit, and therefore I would expect pricing to come down on an overall basis this year.
Right. I just wanted to understand, actually, given the fact that you have the central banks now globally, they are going ahead with these rate cuts. Do you see this aiding any liquidity and hence the demand for luxury goods? Would you like to tie this also all together?
I think more than the fiscal and monetary dimensions impacting luxury goods, because even in you would have seen about 5 years back when there were a lot of uncertainties, the luxury goods market still kept up. So I don't think that would be a big dimension of influence in this. I think the more impactful model would be that people would potentially tend to believe that there is an opportunity for them to optimize on costs and optimize on pricing. And therefore, there would also be a customer expectation in terms of reduction in prices this year. And there has also been discussions on where the sources are, etc. So to that extent, I think customers would also demand more from a value perspective. So to that extent, that would be the driver rather than really fiscal and monetary policies of governments.
So good to have you on the show. Thank you so much for your time today. Okay, that's the view coming in right now from the house of Deloitte. Nifty, meantime, 24,000. HDFC Bank, ICICI Bank already hitting fresh highs. And what a big move coming in from IT. Not just Infosys, but look at what's happening on a Tata Elxsi, for instance. Across the board, in fact, you're seeing stocks bounce up quite smartly in trade. We'll take a very quick break, continue tracking markets on the other side.